Welcome to Edgemoor Investment Advisors' video presentation of our second quarter 2025 market review and outlook. I am Gay Truscott, and I'm joined today by my colleague Steve LaRosa. Our agenda for today's presentation mirrors the topics discussed in our quarterly newsletter, which can be found on our website, www.edgemoorinv.com. Here are the topics we will cover today. A review of Q2 2025, when stocks hit record highs despite a lot of noise. April 2025, a faded memory. The U.S. economy, still showing remarkable resilience, though headwinds do remain. Portfolio implications and actions, Edgemoor's outlook, and a review of two selected securities. Let's get started. A tumultuous second quarter ended on June 30th, with stock market indices reaching record highs, despite ongoing concerns about tariff and trade policies, slowing economic growth, and geopolitical crises around the world. The S&P 500 index surged 10.9% in the second quarter, and returned 6.2% for the year-to-date period. The Nasdaq returned 17.8% for the 3 months ended in June and 5.5% for the first 6 months of the year. These returns marked significant rebounds from the -3% and -8% returned by each index respectively in the first quarter of 2025. This strong turnaround in stocks in the latter part of the second quarter was led in part by a resurgence of technology shares, which had previously been hit hard by tariff concerns and by China's DeepSeek AI scare. But these concerns proved to be short-lived, as investors applauded strong first quarter earnings reports, ample capital expenditure plans by AI users, and an overall belief that the AI growth story remains intact. The dramatic swings in equities during the second quarter was captured by the VIX, the broadest measure of stock market volatility, which is shown in this slide. It peaked at 52 in early April, before settling back below its long-term average of 20 in May and June. Bonds also posted gains, with the Bloomberg U.S. Aggregate Bond Index returning 1.2% in the second quarter and 4% for the year-to-date period, as many investors flocked to the safe haven of bonds amid equity market volatility. We wrote a preamble in our first quarter report describing the sharp sell-off in global stock markets in the early trading days of April. As seen in this slide, the sweeping new tariffs announced on April 2nd, Liberation Day, sent most major indices into or near bear market territory, which is defined as a fall of 20% or more from a recent high. It was a policy shock that surprised investors and threatened to undermine the U.S. economy, since a prolonged tariff war could slow economic growth, raise unemployment, and reignite inflation. The good news is that we did stay the course and stick to our disciplined long-term investment strategy. We didn't panic and sell good investments at depressed prices. Instead, we stayed the course, which is admittedly difficult during times of market stress. But despite the negative headlines, stocks quickly snapped back from the sharp sell-off to reach all-time highs by June, providing evidence of the effectiveness of our long-term philosophy. Now let's turn back to the U.S. economy. The U.S. economy is once again showing, we believe, that it's the strongest, most resilient, and adaptable economy in the world. Despite all the uncertainties around tariffs, inflation, interest rates, and budget deficits, investors continue to find more reasons to be optimistic. Strong corporate earnings, solid GDP growth, and a remarkably resilient job market suggest that the U.S. economy remains on solid footing. According to the Fed's GDP Now estimate, the U.S. GDP is expected to post a solid growth rate of 2.4% in the second quarter, a rebound from the negative 0.5% in the first quarter. The expected reversal in Q2 is in large part due to a normalizing of trade patterns after U.S. businesses rushed to front-load imports in the first quarter ahead of the threat of higher tariffs. With those pressures having subsided, at least for now, a more normal level of business investment and consumer spending has resumed. Corporate earnings, as measured by the S&P 500 index, have also continued to show solid growth. As shown in this slide, year-over-year earnings have grown steadily since 2020 and are expected to continue that positive trend, climbing 8.6% this year and better than 13% next year. The profit cycle for many companies could be further extended by tailwinds from fiscal stimulus and government deregulation. Finally, the U.S. labor market is still showing remarkable resilience. Non-farm payrolls increased by 147,000 in June, well above the consensus estimate and slightly ahead of May's growth. The overall unemployment rate ticked down to 4.1% in June from 4.2% in May, as shown in this slide. Many observers are now looking to the job market rather than inflation as the key indicator of the underlying health and direction of the economy. But headwinds do remain. Fears about inflation reigniting from prolonged tariff disputes with key trading partners such as Canada, China, Japan, and the EU are top of mind for investors and policymakers alike. The Fed recently increased its inflation forecast for the full year 2025 to 3% from 2.8% previously, reflecting this uncertainty. Higher inflation also risks slowing GDP growth, with the Fed reducing its GDP forecast for 2025 to 1.4% from 1.7% at the beginning of the year. Consumer and business confidence also seems to be waning, as exhibited by disappointing retail sales and worsening manufacturing data in May. It is proving difficult for American businesses and consumers to plan and spend without more economic and fiscal clarity. Finally, concerns about the U.S. debt and deficits have grown with the passage of the latest government tax and spending bill, which is projected to add to the deficit over time. In addition, Moody's downgraded the U.S. credit rating in May, joining other major agencies in stripping the U.S. of its once coveted AAA rating. Amid all this uncertainty, the one thing that hasn't changed is the Federal Reserve's policy stance on interest rates, which have held steady since December. Fed Chair Jerome Powell has reiterated his position many times that any further action to cut the federal funds rate will be data-driven. He recently cited the ongoing uncertainty about the effects of tariffs on prices as the reason the Fed holding rates steady so far this year. He also responded to ongoing pressure from the White House to cut interest rates by stating that absent the current tariff wars, the Fed likely would have already cut rates. We'll see how this all plays out. Either way, the markets are remaining hopeful, currently pricing in 2 rate cuts before the end of the year, which, if they happen, should also provide a tailwind for equity prices. Now I will turn it over to Steve to talk about portfolio implications and actions, our outlook for the markets, and 2 securities we are currently buying for client accounts.
Thank you, Gay. We remain cautious on equities in the near term, given the economic, fiscal, and geopolitical uncertainties. We also consider the broad market to be fairly valued, based on the current forward price-to-earnings ratio of the S&P 500 index of approximately 22 times, just ahead of its 5-year average of 20 times. Still, not all segments of the market carry such high valuations. For example, many stocks in the healthcare, energy, and financial sectors have valuations that are significantly below the market's average multiple, and we continue to look for opportunities in undervalued sectors. Overall, we continue to favor value-oriented, dividend-paying stocks that have strong cash flow characteristics, leading market share, a wide economic moat, and solid growth prospects. We also still like short-term treasury bills, with annualized yields of 4.2% plus for excess cash. Our outlook for the markets is guardedly optimistic, as we believe volatility may continue in the near term until there is more clarity on tariffs and their longer-term impact on the economy. Despite expected short-term volatility, we emphasize to our clients the importance of sticking to a long-term investment plan focused on their specific goals and objectives. We believe that our patient, disciplined approach to individual security selection offers our clients strong long-term return potential in a cost-effective and tax-efficient manner. This discipline guided our actions during the market upheaval in April and ultimately served our clients well. We appreciate your confidence in our time-tested investment philosophy, and we remain steadfast in our belief that the U.S. is still the best economy to invest in over the long term. Now I'm going to present our analysis of 2 securities that we own and are currently buying for clients. I will begin with Citigroup. Citigroup is one of the world's largest banks with more than 200 million customer accounts and global operations in over 160 countries. The bank's core competencies include cross-border services for multinational corporations, as well as investment banking, trading, wealth management, and credit card services. Citigroup shares have outperformed the S&P 500 index on a year-to-date, 1-year, and 3-year basis, as the company has successfully pursued a multi-year strategic restructuring. Under the leadership of CEO Jane Fraser, who took the helm in 2021, the bank has sold off non-core businesses to free up capital, de-risk its business, and unlock shareholder value. We expect further structural changes to result in improved profitability, fee revenue growth, and market share gains in its wealth management business. Additionally, the bank has increased its share repurchase activity, offering further support for the stock. Overall, the bank's significant progress in its turnaround efforts has given investors a high degree of confidence in the firm's ability to hit its medium and long-term targets, offering a catalyst for continued gains. Citigroup shares are still attractively valued, trading at 0.8 times book value and 10.2 times forward earnings, and pay a solid and growing dividend, currently yielding 2.6%. Next, I will discuss Deere & Company. Deere is the world's largest manufacturer of farm equipment, as well as a large producer of construction machinery and lawn and garden equipment. For over a century, the company has been the preeminent manufacturer of mission-critical agricultural equipment, creating what, in our opinion, is a highly valuable brand. The company has a long and successful track record of innovating new products and upgrades to its large installed base of equipment that drives greater machine efficiency. Deere's agricultural equipment helps farmers save on operational costs while also increasing crop yield, which has led to intense brand loyalty and pricing power. The company's products are sold through an unmatched and dedicated dealer network with over 2,000 dealer locations in North America. Deere has spent decades cultivating these dealer relationships, which are a significant competitive advantage for the company. Deere is increasingly adding technology and innovation to its products, from guidance systems to seed placement and spacing and customized spraying applications. These value-added features help their customers increase productivity, profitability, and sustainability. These next-generation products and services also increase Deere's addressable market while allowing the company to generate and maintain healthy margins through various business cycles. Deere generates substantial cash flow, which the company has deployed to buy back stock, increase the dividend annually for over 30 years, and maintain an A debt rating from Standard & Poor's. We expect significant earnings growth over the coming years, given Deere's growing addressable market and structurally higher margins. We believe the stock is trading at an attractive valuation for a high-quality business with a valuable brand, unmatched competitive advantages, and strong growth tailwinds. That concludes our second quarter 2025 video presentation. We hope you found it interesting and informative. Please reach out if you have any questions or comments. Otherwise, we hope you will tune in again next quarter.